And let me kickstart why, what is the motivation of the paper. You know, we fully acknowledge that this is not a good time for European integration, so to speak. You know, there are movements across Europe that wants to bring sovereignty back to national capital. So certainly this is not the ideal situation, because if you have to go towards fiscal capacity and safe asset, you have to give up basically sovereignty, or at least find the proper balance between sovereignty. Second point, we fully agree with many people that say, well, in order to have a centralized fiscal capacity or safe assets, you need to have unity of control and liability, which is a very fair principle in my view, in our view. And therefore, basically, once you acknowledge that, you are still left with a problem. And the problem is how to deal with the transition, how to reduce the cost of shocks to monetary union, and how to reduce the burden of stabilization away from national budgets and away from the ECB, which is in itself constrained by the zero lower bound, be it 0 or be it minus 0.4. Okay, so it's still a lower bound constraint. Now, the other point that we would like to point out to see is that okay, there have been many studies and many technical studies on safe bonds and fiscal capacity. They usually tend to deal with the details. So technical details, how to build up, a safe asset, and there are many proposals out there. Our paper is totally different, because basically what we would like to develop is a framework. It's an analytical framework to basically judge the impact of the proposals. And also we want to find out exactly what is the goal. I mean, it's difficult. It's different to have a goal that minimizes the impact on the economy coming from a shock, or if you want to minimize the cost for specific countries or whatever, or other issues. Let me just recap a little bit the view before the crisis. Monetary policy. The prevailing view was that the monetary policy cannot absorb asymmetric shocks. Basically, it's a famous one size cannot fit all. And so fiscal policy, and at the same time you have fiscal policy constrained by the fiscal rules. So basically you have to develop alternative mechanisms. But at that time they were pretty much underdeveloped. And it was well known before the crisis that asymmetric shocks can actually lead to temporary economic divergence, might become permanent over time if you have hysteresis effects. So the policy prescription before the crisis was basically deepen the internal market, so perceive further integration. Also pursue labor market reforms and product market reforms, and have as much fiscal space as you can. So basically save money in good times in order to prepare for the shock, and let automatic stabilizer work in full during a crisis. During the crisis we learn, I think a little bit painfully, that there are also other issues on top of that. First of all, the so-called doom loop between sovereigns and the banks. So the higher the risk of sovereign default due to insolvencies of the domestic banking system, and the higher basically the risk of the sovereign due to the banks, and the other way around, the risk of the banks coming from the sovereign. Now there is also another factor which has emerged very recently. You might be aware that the Euro Summit at the end of December decided to go for some stricter rules to get ESM support, basically having a single limb CAC, basically only two possible lines for countries. One is a full line with a full memorandum. The other one is a line which is very, very effectively no conditionality, but you have to fully respect the fiscal rules in order to get it. So effectively you have this line for the so-called bystanders countries, or those that are innocent, so to speak, and they are hit by a crisis. And then you have the full-fledged line for countries that are sinners, or they are under a crisis. So effectively, but the most important one of the changes is probably related to the debt sustainability analysis. So what happens if a country asks for some support? Now, according to the proposal, because it has to go through the approval of all the parliaments, because it's the ESM treaty, effectively, every country any country that asks for support will have to go through a debt sustainability analysis. In itself, this might also increase a little bit the doom loop, because, of course, financial markets might be willing to test the situation. Final 2 points. Monetary policy continues to hedge at the brink of a zero lower bound. So basically, it's like one size doesn't fit anybody, and that is might certainly be the situation if indeed the Eurozone economy suffers from another downturn now. Why is that? Because effectively, while in the States the Fed has already moved away from the zero lower bound, and the Eurozone is still pretty much there. So should another crisis hit, there might not be much leeway for the central bank to address the issue. And finally, there's a need for assets to serve as collateral for interbank loans, which have become increasingly collateralized, and repos and ECB funding. And this would be also a way to break the bank sovereign doom loop, and has always been put forward as one of the biggest benefits of the safe asset. Now, back to the proposals. There are many proposals out there, so I don't want to get into all the details, but you can easily summarize these proposals in two main streams, if you wish. So you have ESBs and others similar. And these are proposals that look for a kind of center that issue against the national sovereign bond purchase in the secondary market. So basically, this kind of central entity issue bonds and at the same time buys national bonds in the secondary market, according to some kind of criteria, capital key. Clearly, you have reduced risk due to pooling and tranching and diversification. Some people say, why don't we allow the private sector to do it? Which is a fair statement, I would say, although it's very difficult to achieve the critical mass. The second stream of proposals, if you wish, is the so-called e-bonds. There is a big difference here. Because there is a new issuance by a AAA entity, which you might call it Eurozone budget or a kind of sovereign wealth fund, and the joint guarantee by sovereigns. But then, instead of buying bonds in the secondary market, you have basically loans to national sovereigns to replace the sovereign debt that comes due. What is the difference? Well, there is no tranching, and there is a very long transition period, because effectively you replace the national debt very slowly. And then there are common features among these two proposals. One common feature is that usually these proposals tend to call for safe bond to be capped by 60% of national GDP, and so basically above 60% you have market discipline and you have the risk premium on national bonds. The second kind of common feature of these proposals, they encourage regulation to support. So effectively, you would have probably risk weighting, zero risk weighting for these bonds, might have not a zero risk weighting for the rest of it, for the national bonds, or you might have some capital requirements, reduced capital requirements, or other types of changes in the regulation that would actually favor the use of these bonds. This is what all these proposals tend to say. And then there is the other stream on fiscal capacity. I mean, I'm fully acknowledge that we are talking about something that it's not coming, it's not around the corner. And as you might be aware, also in the Euro Summit in December, there was a proposal to introduce a kind of homeopathic, say, fiscal capacity, and that was dropped out. It didn't find the approval of the leaders of the countries. So it's not something that's going to happen immediately, but there is a stream of literature basically supporting fiscal capacity. What is the difference compared to the safe bonds? Well, fiscal capacity can actually affect directly the fiscal stance in both for the Eurozone overall and in national countries, in single countries. It can take a different materialization, if you want, different forms. First, it could take the form of loans from the center. So in that sense, it would not be totally different from e-bonds. So loans to member states in recession, subject to some conditionality. The rationale is that the center could borrow at much lower rates than the national sovereign, particularly in times of stress. Second kind of possible tool, possible way to kind of use the fiscal capacity through kind of public works and through a kind of central entity or some kind of decision at the center to kind of redistribute the funds across Europe. And that could actually produce fiscal stimulus or restrain at national level. Finally, there is also a possibility of spread, say, horizontal transfers, so spending on welfare and or cyclical needs, so to speak. Typical proposals are the unemployment insurance, which is clearly affecting the fiscal stance, both at the national level and European level, and there are clearly some risks of fiscal dominance and lack of democratic legitimacy. So these are the kind of strengths in the literature when we talk about fiscal capacity. Now, let me briefly introduce the model. So basically, our purpose is not to add another proposal on fiscal capacity or to introduce another proposal of safe bonds, but to try to have a kind of analytical framework to evaluate, to see the trade-offs and see the effects of the introduction of safe bonds and fiscal capacity. So we take basically standard Mander-Fleming model, adapted with some features of a closed monetary union. Has been widely used in the literature, so it's nothing particularly new. And probably the new feature is that we take a kind of two-country setting. One is the core, and the other one is the periphery. You can think of it as Germany or Italy, with the difference that in our model, these two countries are exactly equal, okay, with only one difference, which is the fiscal policy space. So basically, the higher debt burden in one of the two countries. And therefore, the resulting high sensitivity to sovereign bonds. sensitivity of sovereign bonds yields to market developments. The same applies also for a supranational entity. Call it fiscal capacity. So there is another feature of the model, which is this supranational entity, and which can actually issue a single bond with a guarantee from the national sovereigns, and then can purchase existing bonds or issue new loans. So one of the two proposals that I mentioned before. And then there are two distribution rules. One is you try to minimize the aggregate output loss. And second, minimizing differences in output losses. So either the aggregate or minimize the national output losses. The outcome is totally different, of course. So let me go a little bit into the details. This is a typical, again, Mandel-Fleming framework. So you have a demand side, and you see the periphery with the asterisks, and you have real interest rates and expected inflation, and then you have the primary deficit, fiscal deficit, which is D, and cross-border trade, which is also a function of inflation differential, and the relative pace of economic growth, which is Y. You have the fiscal multiplier effect, which is assumed to be the same of the transfer from the fiscal capacity, and this is F. And then you have epsilon, which represents the demand shocks. Then you have the supply side, which is again represented by this equation, which is again inflation relative to expected inflation, and then you have a kind of proxy for the slope of the Phillips curve, if you want, and finally you have again a shock, a supply shock. So these are the two sides. Then on top of that you have what you can call the doom loop. So effectively you have interest rates R and R star that can be seen as a rate of change in bank loans. This is quite important because otherwise the model would become too complex. So we just figure out that this is the interest rate on the loans. And then we have one of the, in the first country it is interest rate is exactly equal to the policy rate. In the other country instead you have an element of kind of the first country is the fiscally prudent, if you wish, with low debt to GDP. The second country is the fiscally profligate country, if you want. And so basically there is a risk premium. And the risk premium in this version is linked to D, which is the primary balance. In a version that we are working on, it will become the debt level, which makes more sense. Okay, so that's just to prevent a question that might come afterwards. So the next version of the model will be with the debt, and so the coefficient captures the bank sovereign doom loop. Yeah, yeah. Model, structure versus discretionary fiscal balance. So we also distinguish between the primary fiscal deficit that is basically endogenous, so it is due to automatic stabilizers, and then the part that is basically discretionary, and that's also quite important. And with this, I'll stop here, and I'll pass to Paul. We'll go into the results.
Okay, thank you very much. To me, the task to explain what is, after all, a complex model in 10 minutes, which I won't be able to do, but I still hope to give you a flavor of what's going on here. So these equations, so we have demand-side equation, supply-side equation, and a doom loop section. You can solve that model, and then you get reduced forms for output in the two economies and reduced forms for inflation in the two economies. I think all the signs which are indicated above the variables are very straightforward. The only thing I want to point out is that the sign on a fiscal expansion in the periphery is ambiguous. And why is that the case? In a way, it's very, here too, in a way it's very obvious. It's because when the periphery economy expands its fiscal policy, it's penalized on its sovereign bond yields and on its on the bank lending rate on the rate on bank credit, which then acts to stem the initial positive fiscal impact. So the fiscal multiplier suffers from this doom loop issue, and as a result, and if the lending channel, bank lending channel, dominates the normal fiscal multiplier, then actually a fiscal expansion would be contractionary. So you don't know what the sign is going to be here. It depends. That's in a way a numerical, or if you wish, empirical question. So that is one thing. The other thing is what's important to realize is the fiscal expansion orchestrated by the fiscal capacity doesn't have that problem. It is always unambiguously positive for both in the for output in the core country and in the periphery country. Why? Simply because it's able to bypass this bank lending channel, right? So. Because then if the fiscal capacity stimulates the economy, then that won't show up in higher risks on banks' balance sheets. Let me start. I mean, there's a lot more I can say, but for lack of time, I won't do that. And we'll skip this too. That is two. Let me immediately go to the next section of the model. So far, in the model, we've assumed that policy variables are exogenous. So the policy rate, fiscal expansion in the core, fiscal expansion in the periphery, a fiscal expansion in the core by the fiscal capacity and by the in the periphery by the fiscal capacity are exogenous. But next we make this endogenous, but rather than putting in simple rules, ad hoc rules, we're doing a scheme whereby each actor, policy actor, minimizes a welfare loss function. We try to keep these as simple as possible. So this is the ECB's loss function, which tries to minimize the deviation from the inflation objective. I'm not allowed to say target. But there is also there is inertia because frequent and big changes in policy rates is socially costly. So there is a brake on this. There's also a cost associated with changes in monetary policy, whereby aggregate inflation for the monetary union as a whole is simply the average of inflation in the two economies. Now, if you solve this, then this is then the policy rule for the central bank. And again, the question mark here on top of the fiscal expansion in the periphery is interesting. If the core expands fiscal policy, then the ECB will react with an increase in policy rates. But if the periphery does so, you don't know what is going to happen, because if the fiscal expansion there puts in motion the doom loop, then actually the ECB may be forced to ease monetary policy in response to this fiscal action by. So you don't know. It's a matter of numbers. So this is the monetary policy authority. Now we go to the national sovereigns. The national sovereigns minimize a welfare loss function in which we have output. So they try to minimize deviation of output from potential, say, and there is a inertial variable. The inertial part can be simply because, for obvious reasons, that it's costly to change the budget. You do that normally only once a year. There are social costs to changing, to pursuing fiscal policy, and obviously there is also you have to reckon with the with the constraints imposed by the Stability and Growth Pact and other devices. So, and if you then solve this, then this is your fiscal rule for the core and for the periphery, where I think the interesting thing to point at is again this question mark. If a fiscal expansion in the periphery may prompt actually a fiscal expansion also in the core, as there are spillovers from the doom loop that's set in motion to the core, which is then forced to ease its fiscal policy as well. I think all the other signs are straightforward. Now, the next thing, or I maybe given time, the final thing I want to say is we have to choose or to make our mind up about what the welfare loss function for the fiscal capacity will look like. This is not obvious. It depends what we want it to do. Do we want it to minimize cyclical fluctuations in aggregate output of the monetary union? In other words, to act as a support device for monetary policy, to ease some of the burden on monetary policy, which could be a very important goal. But it could also be used to minimize, to support cohesion in the monetary union and to minimize differences in the cyclical positions of the countries in the monetary union. And you can actually formalize that. So if the fiscal capacity is trying to minimize cyclical fluctuations in aggregate output, it would minimize Y bar, which is simply aggregate output, which is the average of output in the two economies, with inertia or a cost term, which so a fiscal expansion in the core and in the periphery. The social cost of doing that, because there is overt or latent political resistance to this kind of actions. So you have to take into account that there is a cost to doing so. If you then do the solution, well, there's a lot you can say, but I think what is interesting is that an increase in policy rates by the ECB would give you a fiscal expansion in both economies by the fiscal capacity in order to offset this to some extent. But if you, and by way of illustration, this is the only point I want to make here for now. if we have a welfare loss function for the fiscal capacity where rather than aggregate output fluctuations, it is aimed to, in a way, minimize the standard deviation of between the two countries. So it's trying to minimize the divergence. Then, with otherwise the same cost here, then interestingly, the signs on the policy variable of the ECB is changing. So, whereas you get the if monetary policy is say tightened, so interest rates are increased, then the fiscal capacity would be wise to do the opposite in the case of the core and as compared to the periphery. Why? Because you want to diminish divergence rather than anything else.
Sorry, Paul.
Yeah.
Can you summarize so we can perhaps leave
Yeah.
the details for discussion?
Yeah, absolutely. I think with this, you probably have a flavor of what we're trying to do. Actually, just as a final comment here. So since the model is after all pretty complex, what we've done is we've made assumptions about the numerical values of the parameters, which are rooted in the literature to the extent possible. And then you can run the model as if it is an empirical model, and you can actually show what would happen if you have a demand shock or a supply shock, whether it's symmetric or asymmetric, and then how policy is going to respond. I mean, fiscal policy in the periphery, fiscal policy in the core, monetary policy, and fiscal policy by the fiscal capacity. So I want to leave it at that. This is just an illustration. You have to read the paper to actually see what's going on, I'm afraid.
Appreciate the effort.
Yeah,
Thank you very much.
okay,
Thank
you're
you.
welcome.
So, slides ready as well.
Yes, they are.